So yesterday, the 30-year bond market auction, which basically means that the federal government was borrowing more money, glitched like Mitch McConnell at a press conference. Something went wrong, and not like not as many people bought the bonds as was expected. So when that happened, people then looked to this previous report from the Treasury Borrowing Advisory Committee and found out that in late October, they had actually warned Secretary Yellen that deep down into this report, demand for US Treasuries may have softened among several traditional buyers. And of course, this matters to us in the real estate business and the mortgage business because more or less the bond market dictates mortgage rates. And of course, that has a huge impact upon the real estate market. So when yesterday happened and the 30-year bond market glitched, it also glitched the 10-year bond market and yield spiked, which consequently meant that mortgage rates are also going to go up. Remember, the 10-year is about 300 points lower than you add 300 points to the 10-year and get your 30-year fixed, roughly speaking, although now it's like about 290. So yesterday, when Robert Burgess from Bloomberg said, did the 30-year bond market just glitch? He was talking about the fact that the 30-year spiked after a sale of $24 billion in bonds, received far less demand from investors than the government is used to, according to Holger Zeppelschwitz, who's a German bond trader. Primary dealers, in other words, the big banks, are obligated to finance whatever portion of the Treasury auction isn't purchased. So for the pleasure of facilitating this transaction, if nobody's out there to buy Treasury bonds, then the dealers, the people that make the market, the big banks here in the United States, they have to buy what doesn't get bought. And yesterday, they bought 25% of what didn't get bought. And they usually buy more like 12%. So they had to double the amount of their purchasing, which, to me, simplistic Jack, no economics degree here. But the big banks, who are the big banks really? They're really kind of us in a way, right? And so when we're buying our own debt, that just screams to me to be slightly a little even more exponentially inflationary. But, who am I? What do I know? I'm just a little old real estate broker here in Massachusetts who figured out how to stream on YouTube. So this all fed, it is a perfect story for Zero Hedge. If you know the kind of the flavor of the articles that they get at Zero Hedge. Stocks tumble, yields surge after catastrophic 30-year auction stops with the biggest tail on record as foreign demand craters. So what happened? The story up till now is that because of the escalating national debt, which I brought you this chart from Axios the other day. Look at the projection for the share of the U.S. debt to GDP over the next 20 years or whatever this is, 25 years. It's exponential, going up to 180% of GDP out in 2050, which I know it's not around the corner, but it's not that far, especially when you're starting to buy 30-year bonds. So that was really bad news for what interest rates might be on the near term and the long term yesterday, when the market basically regained everything that it had lost, or if you want to think about it the inverse. Remember how we had that slide down in mortgage rates over the last week or so, where mortgage rates dropped by like 0.6%. It went from basically 8% down to 7.4 in like a week. Well, yesterday, it basically regained almost all of that. It retraced almost all of that, and mortgage rates are now back up to over 7.5. They're 7.55, according to Mortgage News Daily. So yeah, it gave all that back. And I was looking like, like I told you, I'm not buying this short-term dip in rates. I think rates are going to go back to 8. I've been telling you that. That's how I feel about mortgage rates because of the debt situation, the Treasury situation, and the inability of the Fed to counter what the Treasury is doing. So all of that happened, and it was pretty scary for the future of U.S. borrowing. And also, we had Powell yesterday speak. He once again got interrupted by climate nuts in the beginning of his speech, and somebody dropped the F-bomb during the whole it was pretty funny. Anyways, now this morning, according to the Wall Street Journal, we're being told, and I don't want this channel to become into some type of financial conspiracy channel, but now we're being told by the Wall Street Journal and the Guardian that no, it wasn't a soft demand that we were officially warned about in the October 31st Treasury press release. It wasn't soft demand. Oh, no, it was just a ransomware attack at a bank in China. Yeah, ransomware attack at a bank in China. Ransomware attack on China's biggest bank disrupts Treasury market. American arm of ICBC is latest victim of hackers, and it is investigating. And it's this ransomware attack that disrupted trades in the US Treasury market on Thursday. So the whole thing about not enough people who want to buy our bonds, no. It was just a ransomware attack. It was just a ransomware attack. So if you read this story in The Guardian, produced by Reuters, is that how you say that? And you go way down to the bottom of the story, you actually find out that the headline itself is BS. Some market participants said trades going through the bank were not settled because of the attack and it affected market liquidity. The last sentence of the article refutes the headline of the article. It was not clear whether this contributed to the weak outcome of the 30-year Treasury auction on Thursday. You see, when you have a Treasury auction, basically the government going to borrow money, it's just like Lending Tree. Remember the old tagline from Lending Tree, when banks compete, you win? And right, if you have a lot of banks who want to lend you the money, they are going to compete and offer you a lower rate, and therefore you're going to get a lower rate for your car loan or your mortgage or whatever it happens to be. But if you only have a handful of banks who want to lend you money, then there's not as much competition for your loan, which they consider an asset, and therefore you're going to pay a higher rate for that car loan or whatever it happens to be. And that's exactly what happened to the 30-year Treasury market yesterday. And it's incredibly embarrassing and very dangerous for the U.S. economy and mortgage rates if nobody wants to buy our bonds anymore, or not enough people want to buy our bonds anymore. I don't want to say nobody, but not as many. Yeah, that's probably the best way to describe it. That demand has softened. If demand has actually softened, that is really bad news for us. That's really bad news for us. So out of the blue, you get this article explaining that, no, it wasn't a softening of demand. It was this ransomware attack. Don't you worry. Don't you worry, it's a ransomware attack, which gets Zero Hedge, and they're kind of conspiratorial, just a teeny bit, asking the right question. So the U.S. Treasury market was allegedly crippled by a hack of China's largest bank. They're not buying it either. And if that is true, isn't the bigger story here that a Chinese bank can paralyze the $75 trillion U.S. bond market? And that is the right question to ask, right? This simple explanation story that it was a ransomware attack is, they're not asking the right question. If a ransomware attack can cripple the bond market, whoa, that's almost that's as big a story as soft demand for bonds. right? That's as big as a story as soft demand for bonds. So we're going to have to follow this as time goes on. As I said yesterday, mortgage rates jump back up 0.14 yesterday, back to 7.55. Now, since the Wall Street Journal article has come out this morning, I was noticing the price action on the 30-year Treasury. Here it is here. Basically, it retraced the dropping of this Wall Street Journal story, basically retraced most of the glitch from yesterday. But I'm just not buying it. I am not buying it. I don't want to be a conspiracy theorist here, but I am not buying it. The 10-year Treasury is now just under 4.6. It was 4.6 when I came in this morning, and it's lost a little bit. So there is definitely something strange going on with our bond market. We got to have to keep a real close eye on that.